Well, we certainly have a very powerful engine in earnings, and we're also being helped by accommodative monetary policy. But I really believe investors just haven't factored in the possibility of a very significant trade war. They don't have a frame of reference.
But how do we factor that in? If we believe we're going to enter an action, because we're not in a trade war right now, are we? Not yet.
You could argue that we are in the early stages of a trade war with multiple parties, because it's not just China, it's Canada, it's the European Union. It looks like the Trump administration is going to move forward with auto tariffs.
That would be one that would be big, because then Europe would have to retaliate in a big way. China may retaliate. There's this $200 billion. How do we factor in what we don't know?
Well, that's the hard part. So investors should assume that it's business as usual for now, but start thinking about diversifying and downside protection in this kind of environment, because we could see a pretty significant sell-off.
Is it about buying safety then? How do we buy puts? How do we protect ourselves?
Well, within one's equity portfolio, diversifying, ensuring adequate exposure to small caps, which have been less vulnerable, tech, which has been less vulnerable so far, and also dividend-paying stocks, because they tend to just exhibit less volatility.
Is there room for utilities, boring old utilities?
Absolutely. There's room for it, and it makes sense in this environment.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.